Welcome to This Week in Money. I'm Jim Goddard. Today, an exclusive interview with WallStreetWindow.com's Mike Swanson. He's very concerned people are investing more than they can afford to lose in equity markets. Swanson also says the U.S. government plan to spend its way out of trouble is seriously flawed. We'll talk to Mike Swanson right after this.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtney, Campbell River, Surrey, Kelowna. Details at RandyElvisFrisky.com. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show and Happy New Year, Mike.
Oh, thanks a lot.
We've seen a hell of a ride for the equity markets in the past year. We have the new year showing up. Is this a good place to be?
Well, it's very fascinating because, this time of year I like to sit back and actually I ask myself that question. After Christmas, things kind of settle down and you can get away and really focus on what you think is going to happen in the next year, where we've come, what are the big trends. And, if you go back to January 2013, the typical person in the United States is actually a little worried because this fiscal cliff thing was all in the news. And, I run a financial website, and I can see the statistics for traffic across the internet using Google and so forth. And there's actually a huge drop in the number of people searching for investments and stock trading and all this kind of stuff exactly a year from now. And what has happened is the market has done very well, the U.S. stock market last year. And now all those worries are completely gone, and there's actually a huge increase in the number of people wanting to get into the stock market that are searching for these things on the internet. And you can see these investor sentiment surveys. For example, the Investors Intelligence Survey says 61% of the advisors they polled are now bullish. And that's a level not seen since October 2007. Which is amazing. And the number of people bearish is at the lowest point in this survey since months before the 1987 stock market crash. So what I'm saying is people are very, 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 very bullish about the U.S. stock market. And from a contrarian standpoint, that's actually quite worrisome for 2014. In fact, one of the scariest statistics is that the level of margin debt, this is people borrowing money to buy stocks in the United States, is at levels seen again in October 2007 and in 2000. So the market has just really made people want to chase the rally and buy more stocks and even go in debt to do it, which is absolutely amazing. And I think that's actually a very worrisome sign. I don't think that means we're going into a bear market, but I think it means that there's so many crazy people in the market now that a dangerous herd is in fact formed, and they could panic and cause a correction. And I think that's what's going to happen in the first couple months of the year. Something like the flash crash maybe, or a drop over 3 or 4 weeks. 10% drop is what I'm thinking could happen. A move to the 150 and 200-day moving averages for the S&P 500 and the Dow. And those are moves that typically happen every year. You usually get a correction down to those levels. But we didn't have one in 2013, and that makes it even more likely. And now everyone is leaning this one direction to be long and to go in debt to do it, and those are the kind of people that can sell in a panic.
Yes, well, right here in British Columbia, the Lottery Corporation has a little slogan, play within your limit. Know your limit, play within it. And I think maybe perhaps in the markets people are ignoring that.
It definitely seems so. I mean, that's what these statistics say. I don't know who these people are. I mean, I don't know any of these people myself. And if I did, I would tell them, get off that margin. You know, the market's run up already, and at this point, it's totally crazy for someone to hold positions on big leverage. You want to use, you know, you can never guess the top of a market rally. And if you do, you got lucky and you can't expect to do it again. And what that means is that if you want to take profits or get off margin or something, you can't try to time it perfectly. You just got to get out. And I think actually today, this is the first trading day of the year as we're speaking. It does seem some of that is happening. I'm sure there's plenty of people that had gains and decided they're going to hold and wait till the beginning of this year to sell so they can delay paying the money they're going to end up owing to the government for another year. So I'm sure some of that's happened, but that's it's going to be a fascinating year, and I think that's what I'm looking for is a correction. I don't think today is the start of it. I actually wouldn't be surprised if the market doesn't hang in there or make a new high even in January, but I definitely think that the rally will peter out probably this month and have a big correction in February, March, and then it'll be time to buy into things. But I don't personally think the U.S. stock market is really a place interesting to invest anymore. We've had a 4-year-long cyclical bull market. The average bull market, if you go back to 1900, lasts about half that long. This will be the 5th year. And often, though, what you get after a bull market isn't necessarily an immediate bear market, but a period of time that can last from a year to even 2 years, in which the market just forms a big top. It doesn't really go anywhere. And in fact, it can even make new highs at the end of this topping process. And during it, there'll be some stocks that continue to do well, and other stocks, though, that just get smashed and enter bear markets ahead of everything. But what happens is the leadership in the market narrows to just a few select stocks. If you think back to 2007, most sectors in the market that year were actually already in a bear market before the final top came in, but a couple stocks, it was Google and Apple, and it was 2 other tech stocks, they escaped my mind, but they were leading the whole market, and making up like 10 or 20% of the gains, and they finally topped out in the fall of that year. So I think something like that is likely to start to occur in this new year at some point, but we're still, those divergences aren't beginning yet, but I think they will.
Mike, I know your newsletter is always a good thing to follow if you want to see what the trends are. When's your new one coming out?
Well, I actually just put one out yesterday morning, right at the beginning of this year, and I typically send it out the first Sunday of every month usually, but I did it a little early this time just to get everything out there. But, I'm talking to the U.S. stock market and so far, and I do think that there's markets elsewhere that provide for still great investment opportunities. The problem with the U.S. has just gone up for several years, and it's in a mature bull market regardless of what is going to happen in 2014, and the stocks in the United States as a whole are overvalued. Something like 50% of the stocks in the Dow are trading at P ratios above 20. They're at essentially 50% to 75% over their mean valuation level, And the same thing is occurring in the S&P 500. So these big cap, popular, seemingly safe and comfortable names in the United States are the ones that I think are overvalued, and really, whenever another bear market comes, it will be the ones that really hurt people. But if you look outside the United States, there's markets all over the world that actually are only 1 year into a bull market, because they went into bear markets in 2010, 11, and 12, and just started one last year. And the markets are cheap, they're priced low. You can find stocks with high dividends and low PEs and so forth. And I think these types of opportunities will be great to buy once we finally get a pullback in the U.S. So that's what I'm planning on doing, is buying overseas once the S&P corrects to its long-term moving average. And you can look, for example, the Russian stock market has a cyclically adjusted P less than 7, where the U.S. is at 24, and you can find stocks there like Gazprom, which is trading with a P of, I think it's 4 right now. It's one of the world's largest natural gas companies, and it's paying a nice dividend. And I think that's a stock that can double or triple over the next couple of years. But that's just one example. There's companies like that all over Europe. If you want to find a market that's just begun to go up, I think, you can look at the Argentina stock market that went through a terrible bear market, and they're having economic turmoil, but it formed a base and started a new bull market in August of last year. So it's just a few months into one. And then, of course, we've got the gold and commodities story, which by all appearances made an important bottom last year after going through a bear market from 2011 and 2012 to 2013, and they've since been going sideways, forming a base. And I think, they're going to break out this year and be incredible. So there's opportunities out there. It's just the average person in the United States, it just seems like they're so obsessed with margining up into this crap, it's that they don't want to play these things where there's real great opportunities where you can buy something and hold it for 1, 2, 3 years, and just be patient, wait for a correction in the U.S. and you can just load up and I think sit back and a year or two from now sell those positions and be very happy. But people just want to buy these silly things like Twitter and Facebook and whatnot, and it's just they need to do other stuff with that.
We'll have more with Mike Swanson from Wall Street Window next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with trader Mike Swanson from WallStreetWindow.com. Mike, you feel Canada might be in a better position than some countries to weather what could be an interesting economic storm simply because our government has promised it's going to have a balanced budget in a year or two.
Yes, I really think right now that's, Canada is pretty much in good financial condition, and Europe has gone through a debt crisis the past couple of years, and its economy has bottomed out, and it's coming out of that. Frankly, the place I'm the most concerned of, not this year, I think things are going to be fine, but down the road is the United States, because our budget is totally out of whack, and we've essentially lost an opportunity to have it fixed. This year, Congress passed a bipartisan budget agreement that took away all the worries that began the year over this fiscal cliff and kicking the can down the road and all that. And what they've done is increased government spending instead of reducing it or freezing it even. And if you look at the Congressional Budget Office that does budget and economic projections, and they're the one most newspapers or economists or anything you read that wants to talk about the deficit in the United States, these are the figures they cite. And according to the Congressional Budget Office, if government spending isn't reduced, then by 2030 or so, I think it's somewhere between 2030 and 2033, they predict that the federal government in the United States will have a fiscal problem in financing this deficit because the debt will simply be so big. And, that's not that far away. You're talking a little over 17 years. However, what's very alarming is that there's a fellow that has worked for the Federal Reserve, and he was on the Federal Reserve Board of Governors in 2008 or so. And back in 2007, he wrote an internal report for the Fed projecting the crash in real estate prices that occurred and laying out how the Federal Reserve would have to respond to that and what it would mean for the economy. And I read that report he put together in September of 2007, and it enabled me to be mentally prepared and ready for what was to come. Well, a year ago, he put out another report. This is an internal Federal Reserve report, not something that's talked about on CNBC or even the Wall Street Journal. Well, this report pointed out a very interesting thing, and that is that these Congressional Budget Office estimates are work on the assumption that interest rates will stay at their current levels throughout the future. Well, it doesn't take much logic to realize that that's probably not going to happen. Interest rates have never stayed at a magical number for 10 years without moving up or down, and they have nowhere to go but up from here. And, well, the report argues and demonstrates that if the interest rate of the 10-year Treasury bond were to go above 5.2%, that the Federal Reserve and the Treasury Department would essentially default into debts and go bankrupt. Well, what does that mean? He says if we got to that situation, the Federal Reserve would have no choice but to monetize the debt by increasing the quantitative money printing operation. And he projects that if the budget deficit, government spending, wasn't cut within just the next few years, he says 2017, 2018, that all this could actually start to happen. Well, this isn't just a report, put out by someone like me or, Doug Casey or Goldbug or Peter Schiff or Jim Rogers or Mark Faber. This is a report done for the Federal Reserve by a man, Fred Mishkin, who has been, essentially Ben Bernanke's best friend. In fact, this report was the topic of discussion in August at the Jackson Hole Federal Reserve meeting, and what in effect is going on is the press of the United States simply does not report on it for whatever reason, but it's there. Anyone listening to this can go on the internet, type Fred Mishkin crunch time, and read this for themselves. But I think what this means for us as investors is that, the stock market's gone up tremendously in the United States the past 12 months, and you can forget about, you don't even have to worry about nightmare scenarios or something. The simple fact is, if you want to make money as an investor, you don't invest in things that have gone up for 4 or 5 years and are overvalued. You look for things that have already gone through bear markets at cheap valuations. And that's where the commodity markets are. That's where gold stocks are. And if the stuff in this report happens too, in a couple years, that'll be a safe haven anyway. They're going to, that's something you're going to want to own regardless of what happens. If the economy grows, everything's fine, they're going to go up. If, if there's a real debt problem, they're going to go up too. it doesn't really matter, because the thing is, we've already had a little bit of a bear market from 2011 or 2010 to last summer in gold and commodities. It's over, and when bear markets end, you typically get a period of up and down basing to prepare the way for a new bull market that begins when the base of that is of resistance is broken through. So if you look at like the HUI gold stock index, you can see the August September highs is essentially the resistance top of that base, and we're trading below it, building the base. And I think that it's going to break out, and if it does, you're talking about the start of a new bull market that, regardless of what happens in the economy or, you know, what this or that report says, you know, it's a new bull market. Bull markets go up, so that's a great opportunity. I think that's now is the place to make money. In 2012, I personally invested in European markets and European stocks, most of which I still own. But that was a great investment time for those markets because it was the end of a bear market. Well, we now have the same sort of similar investment opportunity for gold and commodities for the next couple months. And I think that's the play for this year. And, you know, I'm very excited about that. The thing is, a year from now, you know, I expect that market to be going up, and, you know, I don't know what the U.S. stock market will do. I kind of assume the momentum is going to end for what we saw the past 12 months, and it'll go in some sort of sideways pattern. I think cheaper markets overseas will do good, but regardless, it makes this time, now this year, a good time to take these positions in the mining stocks and commodities. In a year from now, they'll be going higher. So I really think this is like the last year for a great investment spot for a couple of years to come.
I wonder, with the U.S. owing so much money to China, could China at some point just call their debt and say, pay up or face the consequences? Is there anything they could do if the U.S. couldn't pay them back?
Well, I don't know why they would do that. I think all they can do is just sit there and get as many of the debts paid off as they can and diversify, you know, the money they're getting in return into other markets, and which they've been doing. You know, they've been accumulating precious metals and gold, but they've also been investing in countries all over the world. In fact, if you go to Nassau in the Bahamas, they've constructed a giant casino down there. I don't think it's open yet, but there's a Chinese casino, you know, in the Bahamas that they've built, and that's what they're doing all over the world. They're doing business deals. They're investing in oil companies, in things all over the place, and you know, they're very forced. You know, they have a lot of foresight in doing that kind of thing. But I don't think they have any reason to, you know, want to create some sort of panic in our bond market. You know, and if our bond market does, you know, fall and interest rates go up, which I think is very likely in a couple of years, you know, there's really not much they can do, you know, except get the money they can get. It's just like what the United States, you know, the situation we had in the early 90s in Mexico, in the mid 90s, and in Korea and Thailand and Indonesia. You know, it's essentially you try to suck as much money out of these places as you can before you can't do it anymore. And, you know, the United States and the IMF did that to countries, and, you know, it could be that's what's going to happen to us.
Besides, why would China want to kill their best customer?
Yeah, that's exactly right. I mean, I just went to Walmart today, and it's all cheap China stuff in there.
We'll have more with trader Mike Swanson from WallStreetWindow.com right after this on This Week in Money.
Randy Elvis Frisky and his Las Vegas show band relive the movie music memories from Blue Hawaii to Viva Las Vegas, in Ladner, Chilliwack, Maple Ridge, Nanaimo, Victoria, Sydney, Courtenay, Campbell River, Surrey, Kelowna. Details at RandyElvisFrisky.com.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with trader Mike Swanson from WallStreetWindow.com. Is there any possibility if the Canadian and U.S. governments really do fall into hard financial times, they'll do the same thing here as what happened in Cyprus, where if you had a certain amount of, or over a certain amount of money in your bank account, the government just swooped in and took it?
Well, I doubt that. What happened in Cyprus is they bailed out the banks by raiding the depositors. It wasn't the government that they were bailing out, but the financial banks. And what they essentially did was recapitalize the banks by taking everyone's accounts. I think the number was $100,000. If you had over $100,000 in a bank over there, they took everything above $100,000 and gave the people IOUs and I think some stock too in return for a recapitalization. But that was all done to bail out private banks. I think, the consequences though for a crisis, if it happens in the United States, how would that impact people, everyone? I think the consequence would be a falling dollar, and a spike in interest rates up to 15, 20%, maybe even 30%, which is what happened in Greece and Spain and Italy for a very brief period of time 2 years ago. The Greek bonds went up to 30% yield. The other countries didn't go up that much, but they went up to about 15%. I think that's what would happen to us for a short period of time. And of course, the real consequence that would hurt the average person is an explosion in inflation. That is the definitely thing that would impact people. And if you're invested in gold, you would benefit. And if you have lots of debts, you owe a lot of money to the bank, you would benefit too, because it'd be easier for you to pay off your debt. So if you go to the bank now and maybe, get a $200,000 loan to build a house, it's possible if all this stuff happened that you'd be able to pay your house off, easier than you would think now at the moment. I would like to give one note of caution though about these kind of things is, first of all, I don't think it's the end of the world or, people really in their mind worry about these things, I think, a little bit too much. And all these kind of crises end. Argentina went through one in 2000. They're actually on the verge of coming out of one now. We saw them happen in Europe. They just last a year or two, typically, and then you pave the way for a real economic growth. When it's over, you kind of clean out the system. But I think the most dangerous thing people can do is just be very, very complacent. And you need to diversify, own gold, own mining stocks, own other currencies, invest in other markets outside the United States. And there's a real dangerous idea that, if the Fed prints money, the stock market will go up, so I can just be in the stock market and not care about anything because the stock market always goes up when the Fed prints money. Look at the past couple of years. Well, the problem with that is that actually doesn't occur. If you look at these crises that I've just mentioned, Europe, Argentina, Mexico in the 90s, there's several in Latin America in the 80s, the Asian markets, Korea, Thailand, Indonesia, Russia in 1998, 97. All the stock markets in all these crises actually go into a horrible bear market. That's what happened in Cyprus, right? 90% decline. Greece, 90% decline. And what that means is the stock market does not act as a safe haven at all. It's a place to watch your wealth be vanished. And the reason why is that the stock market factors in 6 months or so in the future, typically. And when you have a bear market, usually the bear market actually bottoms when things are the very worst. So that means that the stock market, if a crisis like this happens, and it'll be driven by a falling dollar and rising interest rates and falling bonds, well, the stock market will fall as it factors in the increases in interest rates to come. And finally, when the interest rates spike, the dollar finally reaches a bottom and the crisis is over, the news is the worst it is. And people think the end of the world is there. But that's when the stock market, bear market, would actually come to an end. And if you look at Europe, that's exactly what happened in Europe 2 years ago. The Greek stock market in 2012 had fallen 95%. And it was all on TV how terrible things were there, and there are Nazis in the streets even. Just awful stuff. And that was the bottom. You know, that stock market has doubled, gone up even more than 100% since then. And the Cyprus stock market, you know, it was all in the news. I never thought about the Cyprus stock market until it was in the news a few months ago. Well, if you went and looked at the charts after it was in the news, it had already crashed over 95% over 2 or 3 years. So the market falls into these crises. And I don't think the stock market is going to fall and start a bear market in 2014, but it definitely could top out and have a correction very soon and then form what I call a topping phase that can last a year and a half, and then go into a bear market. And what happens in a topping phase is fewer stocks participate in the bull market, and some stocks even just go into bear markets and just decline. And then the leadership of the market narrows, and you can even get in a situation where most stocks are falling, but people don't really realize that's happening because the averages hang in there, sometimes even continue higher. If you look at 2007, for example, the top was in October, but most stocks had already topped out months before the October top. In fact, if you look, I use this software called TC2000 that breaks the market up into over 200 stock market sectors. Well, half the sectors were already in a decline below their 150-day moving averages even months before the final top in October. And in fact, the very last few months, most of the gains in the S&P 500 just came from 4 stocks. It was Apple, Google, I think Amazon, and some other tech stock. It escapes my memory now. I don't know what it'll be, but leadership will eventually narrow in this market again and be led by one sector or just a few stocks. I don't know what they would be or what it is. And I don't think it's Facebook. I can tell you that.
It was Twitter. It was Twitter. They raised $19 billion.
It's just insane.
Yeah. Well, I was going to ask, what about something like Twitter or Google, where they don't really produce a physical product? Twitter's never made a profit on anything. They don't. I mean, they said after they raised the $19 billion with their initial offering, gee, maybe we should have a business plan. I mean,
yeah.
That's kind of backwards, isn't it?
Well, it isn't. It isn't if your goal is to make money by selling stocks to a hungry crowd that's gone crazy, which I think is what the Facebook boy essentially did. He took advantage of people that, just want to get in on something. But as far as a sustainable business in the long run, I mean, Facebook is making a profit, but it doesn't justify the valuation. And, I don't know what Twitter's going to do, but it's very strange. It really reminds me of 1999 and 98, because I was trading internet stocks back then, and you would hear arguments, we don't look at earnings to figure out what these stocks are worth. We look at page views. And Warren Buffett back then famously said, I can't invest in internet stocks because I don't know how to value them. I don't understand them. And he was right. You can't invest in that crap, but you could trade them. So the thing is, though, now, on CNBC last week, I had it on in the morning, and they spoke of Twitter, and they had this analyst on there say he's going to keep upping the price targets. It deserves it, and other people are going to do what he does, is what he was saying. And they asked him, well, how do you value it? And he says, well, you can't look at earnings. You can't look at the balance sheet. You just have to look at the future.
It's like Bitcoin. Bitcoin doesn't have any, value behind it. It's not like a national currency where the assets of the nation back it up. Bitcoin, same deal, isn't it? Or is it?
Well, I actually was talking to someone about Bitcoin yesterday, and I think Bitcoin could be. I wouldn't be surprised if the federal government doesn't make Bitcoin illegal and makes Bitcoin a crime to play with, at some point. They did it with online poker a couple years ago. That was really big in the United States, and people were spending hundreds of millions of dollars or losing hundreds of millions of dollars playing online poker, and just one day suddenly Congress passed a law and made it a crime. I don't see why they won't do that with Bitcoin. I think people should stay away from Bitcoin. I think it's dangerous.
More with trader Mike Swanson next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're chatting with trader Mike Swanson. Mike, I'm wondering about something we were warned about back in the 50s by President Eisenhower. He said, beware of the military-industrial complex. And I know you're very concerned right now about the way the U.S. is spending money on weapons systems that most likely will never be used in anger.
Oh, yeah. Well, I mean, the bipartisan budget deal was very interesting because they essentially increased the size of government spending, and half the money was given to social programs Democrats are interested in, and the other half was given to build more of these weapon systems that aren't even being used in the wars we're fighting in. The F-22 and the F-35 fighter being two of them, and the Navy has a couple boats too that are extremely expensive. But 20, 30 years ago, the Air Force would spend about $35 million to build an F-16, and now it's over $100 million for one of these planes, and they barely even function, and we're not using them in combat. And I think it's a good example of what happens in any industry that the government is heavily involved in. The normal operations of a free market don't apply. If you open up a business, you've got two key things you've got to focus on: the cost of selling your widgets, paying your employees and manufacturing what it is you're selling or providing, and then the price you get from customers. And that is what you deal with. Well, if you are a military contractor, you don't have to deal with a free market. The government sets the price. That means, though, you don't really have an incentive to try to make anything cheaper or more efficient. Because if you were to lower your prices, you're not going to benefit. The government, in fact, it's a risk. The government may ask you to lower it again or something. Whereas if you can keep increasing your prices and expenses and getting the government to pay for it, well, that's in your interest. And that's what these companies have done, since Eisenhower. But it's what goes on in every economic industry that the government is involved in. People are really focused on this Obamacare and escalating healthcare costs. Well, if what's happened with military spending happens with Obamacare, the costs of that are just going to, for healthcare in the United States will explode. I was speaking to someone about the cost of education, and it's sort of the same deal. It's something the government, through student loans, is funding. And when I went to college almost 20 years ago, it cost me $5,000 a semester. Well, someone told me the same school I went to now costs $15,000. So everything is, what's essentially happening, I think, in the United States and all over the world, for the most part, is that political power and economic power is becoming increasingly centralized, and at the same time becoming more and more inefficient. So by centralized, what I mean is the corporations and the government are more and more becoming linked, or indistinguishable from each other. And of course, the most blatant example of that is the Wall Street bailouts and the consequences of that. They essentially, the government bailed out with taxpayer money all these Wall Street banks, which, have huge influence on the Federal Reserve and the Treasury Department and the people who worked for the Treasury Department and worked for Wall Street banks before. I mean, it's just very, which is which, who's controlling who, I don't know. But I know that, everything we've talked about in the whole interview when it comes to investing in the financial markets has all been dictated by the Fed and these Wall Street bailouts from a couple of years ago.
Yeah, it's interesting, too, that a report that came out today points out how much top executive CEOs are getting. They've had something like a 75% pay hike over 12 years. The average person's salary has gone up 6% over 12 years. And they're the ones making the decisions to lay off people, and they're saying, well, it's good for the company. But actually, if it's good for the company, it's good for them because so many of them have stock options. So the more people they let go, the more money they personally make.
Yeah, that's exactly right. And the thing is about, is that figure for Canada?
I believe it is, but take a look what CEOs make in the U.S. I'm sure it's probably the same.
Same, I'm sure. Well, I remember, always in the 90s, in 2000s, before 2008, reading stuff that would say that, well, look, because of inflation, the wages that Americans make haven't even gone up since the 70s.
Yeah, minimum wage has actually gone down since, if you take into account inflation, since 68, minimum wage has been going down.
Yeah, so, but what's happened is, well, anyway, to make a long story short, like 10 years ago, you would read articles about this that showed that essentially it's not that people are just, not making more. Well, now, if you look at the past couple of years, now they're making less, because of inflation and unemployment, and the average American has a lot less wealth than they did 10 years ago. They make less money. And
yes, allegedly the average Canadian is worth $40,000 more than your average American. Never happened before.
Oh, I can believe it.
Although, you ask a lot of people about economic conditions here too. It depends what sector you're in. Although it depends in any country what you're into. If you're a horseshoe maker at the end of or at the start of the horseless carriage era, well, too bad. And I think some sectors are going to go that way too. The post office in Canada is going to stop home delivery. They're upping the price of a letter by almost 50%. So, certain things are going to change and they're going to disappear. Although who's going to deliver all the things that we're ordering online?
You mean they're not going to deliver to your house? You're going to have to go pick up all your mail?
Yep. It'll be sent to a central box per suburb. They call them super boxes. They're just a bunch of mail boxes out in the middle of nowhere where they get broken into all the time and vandalized. But they say they have to do it to save money. They're trying to actually make money. And I don't think the post office was ever intended to make money when it was invented.
No, I don't think so. It's crazy.
Because the old way of getting something to somebody was, are you going to France? Perhaps you could take this letter of mine there and then maybe find someone who knows my friend to give it to them.
Yeah, that's right.
I think we're gonna come down to that again.
Yeah. Well, that's the opposite of, I was saying everything's been getting more and more centralized. In the end, we'll have an opposite trend because it's gotten too extreme.
Yeah, and those delivery jobs, Amazon, they really want to get their drones out there delivering stuff, which means, and the drone will be computer controlled, so there's not even a person controlling the drone. Although you might have a job repairing them when they hit power lines and people.
Yeah.
Those things haven't been figured out yet. Well, Michael, taking a look at the new year, is there one thing that you think is really going to be a huge positive for us? It's going to brighten up our day?
Well, look, I'm actually, besides the way I've been talking, I actually am very excited about the investment opportunities this year holds, even though, coming into this year, I think the market is overbought in the United States. Bullish sentiment has gotten wacky, and I think we're going to get a correction, but corrections provide wonderful opportunities to invest. And a 10% correction, if it were to occur in the U.S., is not that big of a deal, really. And once it's over, I think that's our biggest danger is a correction. And if it happens and it's over, then there's really, for the rest of the year, nothing to be worried about. The risks to investing diminish quite a bit. So I think the year is very simple. Wait for a correction to happen, and then buy into commodity stocks, gold stocks, mining stocks, and if you want, some of these markets overseas. And that's pretty easy to do. All you gotta do is wait. let the market come back down and buy. And that's once an entry point like that comes, you can essentially, I think, will be able to hold from there for 1 or 2 years and have wonderful gains. I mean, these mining stocks, for example, I mean, if the HUI were to just go back up to where it was a couple of years ago, you're talking about gains of over 200%, and I don't see any reason that can't happen.
Happy New Year once again.
Yeah, thank you.
Thanks to our guest, Trader Mike Swanson, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We'll be back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.